Welcome back to part 2 of our chapter 1 video lecture, where we're going to be looking at different types of entities, different types of taxpayers that have to file tax returns. And we're going to be looking at a simple tax formula that basically is a summary of a tax return like a Form 1040. So the type of business entity we're going to be studying this semester in our Accounting 134 class are individuals. That means people like you and me. And of course, most of us heard of the type of tax return that has to be prepared called a Form 1040. And basically, the 1040 form is a summary of a lot of different amounts coming from other pieces of paper here called schedules. Here, number 1, 2, and 3. We'll see all of these during the semester, but there's even more. Here's a Schedule A, Schedule B. We'll see a Schedule C not this semester, but next semester when we start learning about business income taxation. There's even more. We'll talk about a Schedule D at the end of this current semester when we report capital gains and capital losses. If you're a landlord, you'll probably have rental income. That's a topic covered next semester in our Accounting 137 class. If you're a farmer or a rancher, somewhat similar to a Schedule C business, that's reported separately on a Schedule F. So all of different schedules would be attached to a 1040 form for an individual taxpayer. Again, people like you and me. Now, there's other ways of running or holding a business. For example, you heard of the term corporation. Large businesses are run through corporations, and they don't file a Form 1040, but file a Form 1120. And there's also schedules and other forms that would be attached to this 1120. Another type of business entity is a partnership that files a different form called a 1065. Both corporations and partnerships are not covered this semester, but continue on to next semester, Accounting 137, and you'll learn how to prepare this 1120 and 1065. Now, in the previous video, I showed you how to find tax forms and instructions, but to make things simpler, what I've done here in our Laulima class website, off to the left side is a link called Tax Forms PDFs. So if you click on that link, here you'll see a listing here on the left side for federal IRS forms and for Hawaii forms in this right-hand column. I put the common ones here near the top like that 1040 we just talked about, or this Schedule 1 or 2 or 3 or A, B, C, and so forth. Looks like this one is here's a C. And right now, what's current is the 2020 forms. Eventually, when the 2021 becomes available, probably in October, I'll put the links over here. But you can click on the year and then on this link here, and you can see the form open up in a separate tab. And then you can download it, yeah, and start filling it in. So this one is for individuals. So if I want to get a corporation, I have it listed down here, Form 1120. Here's an 1120 form for a corporation. Yeah? Again, we'll learn about these other types of business entities and the way we report their taxes next semester. Let's go back to our PowerPoint. Here is a simple tax formula. Instead of looking at all of the lines on a 1040 form, what you can do to summarize the information is to put it in these 10 lines here versus a couple dozen lines on the 1040 form. So at the very top of the formula is all the different ways we have income or make income. And this is just the total of those amounts. Examples of income and we'll learn a lot of these different types in chapter number 2. Here's some examples. So the most common type, of course, is if you work as an employee for someone else, you would get a wage or salary. And after the year is over, your employer is going to give you a form called a W-2. And the amounts on this W-2 form would then be recopied and put on the 1040 form. Or if you have money in a bank or savings account or credit union, or maybe even the government will pay you interest, the payer is going to report it to you after the year is over on a form called 1099 INT. Okay, and you would have to, again, summarize it and put it on the 1040 form. If you own stocks in a company, a corporation, or a mutual fund or exchange traded fund, that type of investment may pay a dividend that's taxable. And after the year's over, they're going to issue a form called 1099 DIV. Retirement income reported to the taxpayer in a form called 1099-R, R for retirement. Social Security income is reported by the Social Security Administration to the taxpayer on a form called SSA 1099. We'll learn about these items here in chapter 2. At the end of the semester, we're going to learn about something called capital gains and losses. And many times that's reported to the taxpayer on a form called 1099-B, B for broker. Again, you would combine all of these incomes or report them on a 1040 form. But what we do on the tax formula is just take one big total and put it here in this gross income line. Now what we get to do is to subtract out, to deduct costs. Some of the costs are deducted here, called deductions for adjusted gross income, which is the next line, the difference. Or some deductions are deducted over here called itemized. Yeah, where's my pen? Itemized deductions. And you see the word here, or, yeah, not and, but or, the standard deduction. And of the itemized deductions or standard deduction, we're going to deduct the larger of the two. More deductions, the better, because we want to save taxes. So you look at the itemized deduction amount total, and you look at the standard deduction, and you pick the larger of the two, and you subtract it out from this adjusted gross income line. Examples of itemized deductions we'll see in Chapter 5. Common ones include home mortgage interest. If you buy a home and pay a mortgage, the interest would be deductible here. Or charitable contributions, or possibly medical costs. Even the state income taxes you pay, real property taxes you pay, may be claimed as itemized deductions. But for most taxpayers, the total itemized deductions they have is probably going to be less than the standard deduction, unless you probably have a home mortgage or major medical health costs. For most taxpayers, the standard deduction is going to be bigger than the itemized deductions. Standard deductions, we'll see that topic calculated in the next video, for chapter 1. Another deduction here is called qualified business income deduction. Because it's business related, we will save that topic for next semester in our Accounting 137 class. So we deduct deductions up here, deductions over here or over here, and again over here to come out to this line called taxable income. Now, it's important to deduct them in this certain order. Deductions up here for arriving at adjusted gross income, and then deduction itemized or standard deduction to get the taxable income. Now, some examples of deductions over here for adjusted gross income include any business type expenses, Okay, you're already claiming business income in the top line under gross income. Now you get to deduct business expenses, related business expenses. Not too common, well, not clear here, but if you're an employee, that's not generally considered to be a business, yeah. But if you get reimbursed by your employer, you can offset your expenses. So really nothing has to be reported as long as the reimbursement is claimed as something called an accountable plan. And we'll talk about that probably in I think chapter 5. Alimony depends upon whether you're paying the alimony or receiving the alimony. Now, if this divorce, the related divorce, took place from 2019 onwards, you can ignore alimony. But if the divorce took place prior to 2019, if you received alimony, that's going to be included here in your gross income. If you paid alimony, that's going to be a deduction here in the next line to get to the adjusted gross income. Again, that's for divorces that took place before 2019. Divorces that took place in 2019 and after, you pretty much ignore alimony for tax purposes. If you borrowed money to go to school and you're paying off interest, the lending institution will give you a form called a 1098E, I guess E for education, showing you how much of the interest may be deductible. And we'll learn about the calculation of the deduction in chapter 5. If you have interest income, we saw that in the previous page to be taxable over here. But for some banks, some financial institutions, if you take out your money too early before a so-called maturity date, they may penalize you and charge you a penalty. That penalty may be deductible here as a deduction for AGI. AGI is adjusted gross income. Yeah, we'll see putting money into a retirement plan that may be claimed as a deduction in chapter 5. If you're a K to 12 teacher, educator, you can deduct up to $250 of costs you incur for your job as a deduction for AGI. So again, those type of costs are deducted over here to get to the AGI amount. Then you deduct itemized deductions or standard deduction, which we'll see in a second and in the next video, to get to taxable income. The bigger the taxable income, the bigger your taxes are going to be. The smaller your taxable income, the smaller your taxes are going to be. Now, how do you calculate out the tax? Here in the next line, we're going to multiply that taxable income by a tax rate. Rates are usually percentages, and the instructions to the 1040 form will help us calculate out the tax by something called a tax table or a tax rate schedule. If your taxable income is less than $100,000, you would look up the taxable income on the tax table to figure out the tax for the year. If your taxable income is greater than or equal to $100,000, then you have to use something called the tax rate schedule to figure out your tax. So maybe I'll go through an example demonstrating both. So your tax for the whole year after using the tax table or tax rate schedule is called the tax liability. Again, this is the tax for the whole year. Now, there's other taxes you may have to pay here called additional taxes that we'll see this and next semester. But the main tax is this income tax liability for the whole year. And our tax system requires taxpayers to pay during the year and not after the year is over when you file your tax return. Yeah, we use a pay-as-you-go system. So the taxes they take out, income taxes they take out from your paycheck, That's called a prepayment or withholding. Some people may have to pay during the year taxes on their own to the government. That's called estimated taxes, here also classified as prepayments. There's another thing that we get to use called tax credits that will offset the tax dollar for dollar here. Even though we're subtracting out the tax credits here, tax credits are not the same thing as tax deductions, which is subtracted from the income. If you have $1 of deductions, that doesn't save you $1 in taxes. It saves you a percent of that $1, whatever tax rate you're going to use. Whereas if you have $1 of credit, that's going to save you, offset $1 of taxes. Again, $1 of credit worth more than $1 of deduction, even though both are being subtracted out in this formula. We're introduced to something called recovery rebate credit here in Chapter 1. I may prepare another video to calculate that out, yeah, but I believe most of the credits we're going to be learning during this semester are covered in Chapter 6 or 7. Now, if the amount of tax you have for the whole year, tax liability, is less than your credits and your prepayments, the excess is going to be an overpayment that you can have refunded to you, or you can apply it as a prepayment for next year's taxes. But if your tax liability is bigger than the tax credits and prepayments, you have a balance due here or tax due that you have to pay when you file your return. Now remember, the money you get back is called a refund and not a tax return. The tax return is the whole form here, the Form 1040 that you're filing with all the tax schedules, filing it with the government. The money that you get back from the government is called a refund. Let's take a look at the 1040 form and see all these same terms here, yeah? Let's go look at the 1040. So where shall I go? Let's download one again here from our Laulima site. And let's zoom in here. So all the different types of common income, wages, interest, dividends, retirement income, Social Security, even that capital gains are listed here, lines 1 through 7. And you will take a subtotal here in line 9. If you don't see the type of income you have listed here, you can probably report it here on a separate schedule number 1. Yeah, and then put the subtotal here on line 8 and then add it into line 9. So what they call here total income, our textbook calls it gross income, all the income that's taxable for the year. Then we would subtract out adjustments for adjusted gross income. And those would be listed on a separate schedule, like that student loan interest or the alimony that's deductible. For the year 2020 and 2021, the government is allowing you, I think, up to $300 per taxpayer, a charitable contribution here versus claiming it as an itemized deduction. In other words, a deduction for AGI, yeah, versus a deduction as an itemized deduction. That's for 2020 and 2021. I don't think it was mentioned in our textbook. So when you subtract out your gross income and the adjustments, we get adjusted gross income. You notice the words are bold here: total income, adjusted gross income, the same terms we see in the tax formula. Then in the next line, we deduct standard deduction, or, remember, not both, itemized deductions, the larger of the two. Off to the left side here in the margin, you can see some common amounts for standard deduction. But again, we'll have another video to calculate out all different possible standard deductions. Our next video. If you are going to deduct itemized deductions, those have to be reported on a separate form called a Schedule A and attached to our 1040 form. Here's that qualified business income deduction we'll talk about next semester. And then after subtracting out standard or itemized, here's that taxable income number that we're going to be multiplying by the tax rates either on the tax table or tax rate schedule to calculate out the tax for the whole year. Here just called tax. Our tax formula called it tax liability. Then we subtract out credits. Here's credits. Here are, let's see, more credits. Here's more credits, more credits. A lot more credits probably covered in a schedule number 3. Our textbook here in chapter 1 briefly talks about recovery rebate credit. Okay, so that's going to reduce the tax way up here. Now the taxes you paid on during the year from your job, that's reported on that W-2 form, or other ways, other taxes withheld here in the 1099 form, is claimed over here and subtracted out from the tax. So the bottom line is either you're overpaid for the year, where you want to get back a refund, or apply to next year's taxes, here called estimated taxes. Or if you didn't pay enough during the year, then you have a balance doing here called O now that you have to pay with the tax form, this 1040 return. If you want to get your refund faster, you can have it direct deposited into your bank account, filling in this bank information. It's also possible to have a direct debit from your bank account if you owe. If you file by paper mailing it in, you would need to probably attach or enclose a check with your 1040 form, payable to the United States Treasury. Okay, what else? Let's stop here. No, let's do an example of a tax calculation. So back to our PowerPoint. There is another deduction mentioned here called exemptions, but for the years 2018 all the way out to 2025, it's 0. You don't get to deduct it, but it may come back. The exemption amount is roughly 4,000 something, and it does come into play with other amounts being calculated on the return. But for the current year all the way out to 2025, it's not a deduction. Let's take a look at this self-study problem. Make sure you do the self-study problems as you read through the textbook. And the solutions, I believe there's probably a link at the bottom of our ebook for each self-study problem to display the answer. Or you can jump to Appendix E and you'll see something like this, the solution for the self-study problems. But what I want to do for this one is to not fill in the blanks here, but to actually fill in the amounts on the 1040 form. What we're told is Bill, our taxpayer, is single. Single is the filing status. We're going to learn about filing statuses in our next video. He's age 27, so his standard deduction is going to be very standard. If you have 65 or older, you get an extra standard deduction. So his salary or wage is $29,000. That's reported to him on Form W-2. He has interest income of $1,500. That's probably going to be reported to him on Form 1099 INT. He may need to also fill in that amount on a Schedule B that you attach to the 1040 form. He has deductions for AGI, just like the student loan interest or possibly alimony. That was mentioned examples here in this video. And he has itemized deductions of $6,500. Keeping in mind, you deduct this 6,500 or the standard deduction, whichever is larger, eventually coming down to taxable income. We're not asked to figure out the tax liability, the tax for the whole year. We're told to stop here, but I'm going to show you how to calculate out the tax. But let's take a look again at the 1040 form. Let's see if I can put up my screen in two here. So we're not given enough information to fill in everything, but our taxpayer's name is Bill, and he is single filing status, yeah, versus these others that we'll learn about in the next video. We're not given any other information for up here. We're told that his wage or salary is $29,000 in box number 1. We're told his interest income is $1,500. That's in box 2B. There's no other income items we're told. Let me make this bigger again. So the total income, gross income or total income, is $30,500. His adjustment deductions here. We weren't told the exact category of deductions, but the total is $2,200. So subtotal of that deductions are $2,200. And if we take the difference, I need my calculator. I cannot do this in my head even though I'm supposed to be an accountant. 30,500 minus 2,200 equals 28,300. So let me copy that and paste it here in this line called AGI, Adjusted Gross Income. His itemized deductions, we're told, are $6,500. But what we got to do is compare that itemized deduction with his standard deduction. So in the case of a single filing status taxpayer, the standard deduction typically is this $12,400. Again, which is larger than the itemized deduction. So we deduct that larger amount, $12,400. And let's see, total deduction here, $12,400. And the bottom line is a taxable income subtracted from the AGI line. So where's my calculator? Minus 12,400 equals $15,900. Let me double check that my answer here. So that's here on the next page, 15,900, yeah. Now let's take it one step further. Let's calculate out the tax liability for the year. And because my taxable income is under $100,000, their requirement is to use the tax tables. So let's go look up the tax tables in the instructions to this 1040 form. So here is my Laulima listing of forms and the instructions for 1040. Okay, I download it and I look for the table, the pages with tables and tables of numbers. Not this one, but here. Now, what was it? 15,000? 15,900. Let me zoom in here. 15,000, and I go down these two columns. And notice that 15,900 appears here and over here. Yeah, 2 times. But make sure you read the top of the column. 15,900 is at least 15,900. But 15,900 is not less than 15,900. So you don't use this first one here, yeah, in the second column. You got to use this row. So once you identify the row you're going to use, look up here for the filing status of our taxpayer. In this case, it's single. So the filing status column and the taxable income row where it intersects, this 1714 is your tax liability for the year. 1714. And then I would subtract out any credits. I would subtract out any taxes that were income taxes withheld reported on the W-2 form, which were not told, eventually to get the amount of refund or tax due. Now let's change the numbers here. Let's assume that the taxable income has one more zero in it, yeah? 159,000. Now because it's more than 100,000, you cannot use this tax tables. The tax table only goes up to just under $100,000. And if it goes over, here we're told to use something called the worksheet, which is pretty much the same thing. Let's see if the worksheet's over here. This is pretty much the same thing as the tax rate schedule. I believe the tax rate schedule is on page 111 of this instructions. Tax rate schedule. And there's 4 different rate schedules here. One for our filing status for single. So let's see if I can use my calculator again. Now, what was my taxable income? 159,000. So I go down these 2 columns looking for where the 159,000 falls within. It falls within this row right here. It's over 85,525, but not over this 163,000. So if you kind of follow the descriptions up here, let me bring up my calculator. What you got to do is take your taxable income, 159,000, and you subtract or get the excess over this first amount here. You see that 85,525? You cannot see it over here to you at the end. So I minus 85,525, and the excess is this 73,475. That's going to be taxed at this rate of 24%. So I multiply by decimal 0.24, 24%. So here is the tax just on that 73,475. But you still have to figure out the tax on this 85,525. And that's built into this number right over here. Yeah? This 14,605.50. So what I got to do is I got to add it to that previous tax. And here is the tax for the whole year. 32,000, and I round to $240. That's assuming his taxable income is this 159,000. Yeah? And the tax here would be just what I figured out from the tax table. This 132.40. Okay? So that's an example of using this tax rate schedule and this tax table, yeah, in the instruction book to our 1040 form. Yeah. Okay, let me stop here and go ahead and continue with the next video that talks about filing status.